Should a Bitcoin ETF be inside your retirement account? The answer is not automatically yes because Bitcoin has produced powerful historical returns. It is also not automatically no because Bitcoin is volatile and difficult to value. The real question is whether the position functions as a controlled part of a retirement plan or whether Bitcoin has quietly become the retirement plan. A retirement investment normally has a defined purpose, a target allocation, a time horizon, and the rebalancing rule. A speculative position is often driven by price predictions, fear of missing out, and the belief that the asset must continue rising for the financial plan to work. The same Bitcoin product can function differently in two portfolios. At 2% of a diversified retirement account, it may be a manageable satellite position. At 50%, the retiree's future becomes heavily dependent on one volatile asset. Placing Bitcoin inside an IRA or 401k does not make it safer. The account changes the tax treatment. It does not change Bitcoin's price behavior. So before deciding whether Bitcoin belongs in retirement savings, we need to understand what investors are actually buying. Because a spot Bitcoin product, a futures ETF, and a leveraged Bitcoin fund may share similar names while creating very different long-term results. The phrase Bitcoin ETF is often used as though every product provides the same exposure. It does not. A spot Bitcoin exchange-traded product generally holds Bitcoin through a trust and attempts to track the asset's spot price, minus fees and other tracking differences. Technically, many U.S. spot Bitcoin products are exchange-traded commodity trusts rather than traditional investment company ETFs registered under the Investment Company Act of 1940. For most investors, the practical experience still resembles trading an ETF. Shares can be bought and sold through a brokerage account during stock exchange hours, but the legal structure and investor protections are not identical to those of a conventional stock or bond ETF. A Bitcoin futures ETF does not hold spot Bitcoin directly. It holds futures contracts, which may introduce contract roll costs and performance differences relative to the spot market. Leveraged and inverse products are even more complicated. They usually target a multiple or the opposite of Bitcoin's daily performance. Because they often reset every day, long-term performance may differ dramatically from the simple multiple an investor expects. That makes them especially dangerous as passive retirement holdings. Before evaluating Bitcoin itself, verify what the fund owns, how it tracks the market, and whether the product was designed for long-term exposure. Then comes the next question: can the product even be purchased inside your specific retirement account? Access to Bitcoin products depends heavily on the type of retirement account. A brokerage IRA usually offers a broader investment menu. Traditional and Roth IRA investors may be able to purchase publicly traded Bitcoin products when their broker or custodian permits them. The investor generally selects the position directly. A 401k works differently. The employer-sponsored plan offers an investment menu selected and monitored by plan fiduciaries. Most participants cannot simply buy any publicly traded fund they choose. Some plans provide a brokerage window, but the available investments and restrictions still depend on the plan. The regulatory tone has also changed. In 2022, the U.S. Department of Labor warned fiduciaries to use extreme care when considering cryptocurrency options. That guidance was rescinded in 2025, returning to a more neutral, principles-based approach. But neutral does not mean endorsed. Plan fiduciaries must still evaluate risk, fees, diversification, investment structure, and whether an option is appropriate for plan participants. A change in regulatory tone does not force an employer to add Bitcoin exposure, and legal availability does not establish personal suitability. An IRA may give the investor more control, but it also places more responsibility on the investor to understand the product. Once access is established, we can examine the strongest argument in favor of using a Bitcoin product instead of holding Bitcoin directly. The strongest argument for a spot Bitcoin exchange-traded product is convenience. Direct Bitcoin ownership requires the investor to choose between self-custody and trusting a cryptocurrency platform. Self-custody involves private keys, wallet security, backups, and the permanent consequences of losing access. Holding coins on a crypto exchange introduces platform, custody, and counterparty risks. A publicly traded Bitcoin product moves much of that operational complexity into a familiar brokerage structure. The position appears beside stocks, bonds, and other funds. The investor can buy, sell, monitor, and rebalance the shares through the same retirement account. There is no personal wallet to manage and no private key to protect. Inside a tax-advantaged retirement account, buying or selling the position generally does not create the same immediate annual tax reporting that may occur in a taxable account. That can simplify rebalancing. A small Bitcoin allocation may also provide exposure to an asset whose long-term return drivers differ from the cash flows of stocks and bonds. But owning the exchange-traded product is not the same as personally owning Bitcoin. The investor owns shares in a trust or fund structure. The product reduces some custody and record-keeping. It does not eliminate price volatility, tracking risk, sponsor risk, or the risks of the underlying crypto market. Convenience is a legitimate advantage. It is not a complete investment thesis. And the bear case begins with the type of volatility being introduced into savings that may be difficult to replace. Bitcoin can experience price movements that would be considered extreme for a diversified stock or bond portfolio. Large gains attract investors. Large declines test whether they understood the risk before purchasing. This matters more inside a retirement account because annual contribution space is limited. When retirement capital suffers a severe loss, the investor cannot always replace it quickly by depositing an unlimited amount of new money. Bitcoin's price is also heavily influenced by market demand, liquidity, sentiment, regulation, and investor expectations. Unlike a bond, there is no contractual principal payment. Unlike a profitable company, there are no earnings or dividends supporting a conventional valuation model. Another complication is trading hours. Bitcoin trades continuously. Shares of a U.S. exchange-traded product trade primarily during stock exchange hours. A major Bitcoin move can therefore occur while the exchange-traded shares are unavailable, creating sharp price adjustments when the market reopens. Behavior may be the largest risk. An investor may buy after a rapid rally because the asset feels safe only after it has already risen. The same investor may sell during a large decline because the volatility becomes emotionally unbearable. Before placing Bitcoin in retirement savings, ask a practical question. Could you continue following the plan after a severe decline that lasts longer than expected? If the answer is no, the tax benefits of the account will not protect the investor from a behavioral mistake. Tax treatment still matters, however, and Roth and traditional accounts create very different long-term outcomes. A Roth IRA, traditional IRA, and 401k can hold the same Bitcoin product while producing different tax results. With a Roth IRA, contributions are generally made using after-tax money. Qualified withdrawals may be tax-free, and the original account owner does not face lifetime required minimum distributions under current law. That can make a Roth account appear especially attractive for an asset expected to appreciate substantially. But the logic works in both directions. If the investment performs poorly, valuable Roth contribution space may have been used for an asset that produced little or no long-term growth. A traditional IRA may provide a current tax deduction, depending on eligibility. The investments grow tax-deferred, but withdrawals are generally taxable and required minimum distributions eventually apply. A 401k may contain traditional and Roth contribution sources, but investment availability and withdrawal rules depend on the plan. The important principle is simple. The account changes when taxes are paid. It does not reduce the underlying volatility. Investors should choose Roth or traditional treatment using a broader lifetime tax strategy, not simply because they believe Bitcoin will rise. Current tax rates, future tax rates, withdrawal needs, required distributions, and the rest of the retirement portfolio all matter. After selecting the account wrapper, the investor still needs a reason for owning the asset itself, and Bitcoin is fundamentally different from a stock or bond because it does not produce contractual cash flow. A stock can be analyzed using revenue, earnings, free cash flow, dividends, and the company's future reinvestment opportunities. A bond can be analyzed using interest payments, credit quality, maturity, and expected principal repayment. Bitcoin produces no earnings, it pays no dividend, and there is no contractual cash flow that can be discounted to estimate intrinsic value. Its long-term value depends on a different framework. Scarcity is one component. Bitcoin's issuance rules limit the rate at which new units enter circulation. Network security is another. The blockchain depends on computing power and economic incentives that make the transaction history difficult to alter. Adoption also matters. Demand may increase when more individuals, institutions, companies, or financial platforms choose to use or hold Bitcoin. Liquidity, legal access, and confidence in the network rules can support demand. But limited supply does not guarantee a high price. An asset can be scarce and still lose value if future demand weakens. That is why a Bitcoin thesis should explain more than there will only be a limited number. The investor should identify what would increase durable demand and what evidence would prove the thesis wrong. Without earnings or cash flow, valuation is especially sensitive to expectations about future buyers. That does not make Bitcoin worthless. It makes the investment thesis fundamentally different. And even when the thesis is correct, the exchange-traded product introduces fees and tracking differences that reduce the return reaching the investor. A spot Bitcoin product attempts to follow the price of Bitcoin, but the investor should not expect an identical long-term return. The first difference is the sponsor fee. The trust usually pays that fee using its own assets. Over time, this can gradually reduce the amount of Bitcoin represented by each share. The share may continue tracking Bitcoin closely, but the underlying Bitcoin exposure per share slowly declines as fees are collected. The second cost is the bid-ask spread. This is the difference between the price at which investors can buy shares and the price at which they can sell them. Larger, more liquid products may offer tighter spreads, while smaller products may be more expensive to trade. The market price may also trade slightly above or below the value of the underlying assets. Creation and redemption mechanisms can help keep those differences under control, but they do not guarantee perfect tracking. The SEC's approval of in-kind creation and redemption mechanisms for crypto products may improve operational efficiency. It does not eliminate fees, spreads, tracking differences, or custody risk. A small annual cost may appear unimportant. Inside a retirement account held for several decades, the cost is charged repeatedly and compounds against the investor. Before purchasing, compare the sponsor fee, liquidity, trading spread, tracking history, custody disclosures, and legal structure. The product selected matters, but for most retirement investors, position size will matter even more than small differences between competing funds. If you prefer retirement and cryptocurrency analysis without automatic rejection or automatic enthusiasm, subscribe to Boring Money Wins. The purpose of this channel is to separate the asset, the product, and the portfolio decision. Bitcoin may have a legitimate role in some retirement portfolios. That does not mean every Bitcoin product is appropriate. It does not mean every retirement account should contain it. And it definitely does not mean the largest possible allocation creates the best outcome. If this video is helping you evaluate crypto exposure through risk, taxes, fees, and portfolio construction rather than price predictions, click the like button. That helps YouTube recommend the video to more investors trying to make retirement decisions without being controlled by fear or hype. The account is the tax wrapper. The exchange-traded product is the vehicle. Bitcoin is the underlying risk. Now we need to convert that risk into something measurable. The difference between a 1% allocation and a 20% allocation is not simply a difference in confidence. It can completely change the role Bitcoin plays inside the portfolio. That is why position sizing matters more than the most persuasive story about Bitcoin's future. Position size determines how strongly Bitcoin can affect a retirement outcome. Consider a simplified stress test where every other asset remains unchanged and Bitcoin falls 60%. With a 1% allocation, the approximate portfolio impact would be negative 0.6%. With a 3% allocation, the impact would be approximately negative 1.8%. At 5%, the impact would be approximately negative 3%. At 10%, it would be approximately negative 6%. At 20%, it would be approximately negative 12%. This example ignores correlation, fees, rebalancing, and changes in the rest of the portfolio. Its purpose is to show that the same Bitcoin decline creates radically different consequences depending on position size. A small satellite allocation may decline severely without preventing the overall retirement plan from functioning. A dominant allocation can make retirement timing, future income, and investor behavior depend almost entirely on Bitcoin. The appropriate position depends on risk capacity, years until retirement, job stability, emergency savings, other crypto exposure, and the amount of loss the investor can tolerate without abandoning the strategy. No allocation is automatically conservative simply because it is below 10%. For someone near retirement with limited savings, even a smaller percentage may create meaningful risk. Position sizing converts a belief into a measurable portfolio consequence. Once the target size is selected, the investor needs a rule for what happens when volatility moves the position far away from that target. A small Bitcoin position may not remain small. Suppose Bitcoin begins at 5% of a portfolio and every other asset makes no gain or loss. If Bitcoin doubles, the allocation rises to approximately 9.5%. The investor now owns almost twice the original Bitcoin exposure without intentionally choosing a new target. If Bitcoin falls 60% under the same simplified assumptions, the position declines to approximately 2.1%. Without a written rebalancing rule, investors often respond emotionally. They add money after a major rally because Bitcoin appears safer. Then they sell after a major decline because the investment feels broken. A rebalancing policy attempts to reverse that behavior. Calendar rebalancing reviews the portfolio on a fixed schedule. Band rebalancing acts when the allocation moves above or below a predetermined range. Contribution rebalancing directs new retirement contributions toward underweight assets without immediately selling. For example, an investor with a 5% target might review the position when it moves outside a defined band. That is only an illustration, not a universal recommendation. The useful rule is the one written before volatility arrives. Rebalancing controls exposure. It does not guarantee a higher return, and it may require selling part of Bitcoin during a major rally. That trade-off is intentional. The objective is not to maximize the return of the best performing asset. It is to prevent one asset from taking control of the retirement plan. This becomes even more important as the investor approaches the years when portfolio withdrawals begin. Bitcoin exposure at age 30 creates a different risk from Bitcoin exposure at age 65. During the accumulation phase, the investor may be adding new contributions regularly and taking no portfolio withdrawals. A major decline is painful, but the investor may have decades to recover and can potentially purchase additional shares at lower prices. During retirement, the portfolio becomes a paycheck. The investor may need to sell assets to fund housing, healthcare, food, and other expenses. Selling during a severe decline permanently removes assets that would otherwise participate in a recovery. Consider a simplified example. A portfolio begins with 100 units and declines 40%, leaving 60. The retiree then withdraws 4 units, reducing the balance to 56. If the portfolio rises 66.7% the following year, the ending balance is approximately 93.4. Without the withdrawal, the decline and recovery would have returned the portfolio to approximately 100. The difference is sequence of returns risk. The order in which gains, losses, and withdrawals occur can matter as much as the average return. A volatile asset can intensify that risk when it must be sold during a downturn. Cash reserves, high-quality bonds, and planned withdrawal sources can provide protection, although the appropriate structure depends on the investor. As retirement approaches, risk capacity often declines, even when personal enthusiasm for Bitcoin remains strong. That leads to the practical question of when Bitcoin may fit and when it probably does not. A Bitcoin exchange-traded product may fit inside a retirement account when several conditions are already satisfied. The investor has built a diversified core portfolio. The Bitcoin position is deliberately sized. The time horizon is long. A severe decline would not destroy the retirement plan. The investor understands the product structure, fees, custody arrangements, and tracking risks. A written rebalancing rule exists, and the long-term Bitcoin thesis can be explained without relying entirely on a future price target. Bitcoin probably does not fit when it replaces diversification, when retirement withdrawals begin soon, or when the investor needs stable portfolio income. It may also be unsuitable when the purchase is driven by fear of missing out, when leveraged or daily reset products are being used, or when the investor cannot explain what would trigger a sale. A useful behavioral test is simple. If Bitcoin fell more than 50%, would the investor buy, hold, rebalance, or panic? The answer should be determined before the decline, not during it. Another important question is what happens if the thesis is completely wrong? If Bitcoin never produces the expected long-term return, would the investor still have enough diversified assets, savings, and income to retire? Suitability depends less on how strongly someone believes in Bitcoin and more on how much damage occurs if that belief is incorrect. With those conditions established, we can build a final decision framework. Before placing a Bitcoin exchange-traded product inside a retirement account, evaluate 6 areas. First, the account. Understand whether the investment will be held inside a Roth IRA, traditional IRA, or 401k, and how the tax and withdrawal rules affect the complete plan. Second, the product. Know whether it is a spot product, futures fund, or leveraged product. Similar names can hide very different structures. Third, the allocation. Estimate how a severe Bitcoin decline would affect the total retirement portfolio, not only the Bitcoin position. Fourth, the rebalancing rule. Define the target allocation, review schedule, and conditions for buying or selling before emotions take control. Fifth, the time horizon. Compare the years remaining until retirement with the years remaining until portfolio withdrawals begin. 6. The thesis. Explain why Bitcoin should retain long-term demand and define what evidence would prove that thesis wrong. The final verdict is balanced. A spot Bitcoin exchange-traded product can function as a controlled satellite inside a diversified retirement portfolio. It should not become an unmeasured bed whose success is required for retirement to work. The account is the wrapper. The exchange-traded product is the vehicle. Bitcoin is the risk. No allocation is small when its failure can destroy the financial plan. Own the risk intentionally. Rebalance mechanically, and never build retirement around a prediction. That is how boring money wins, even when the asset itself is anything but boring.